Welcome back to Investing Talk Podcast.
Today we're looking at Intel.
As usual, before we start, subscribe, like, and comment to this video to support the show. Because today we are unpacking a situation that frankly has the entire semiconductor industry holding its breath.
Yeah, it really does.
We're setting the stage for what might be the most massive, high-stakes corporate transformation of this entire decade. I mean, for years, the narrative around this company was that it was a legacy dinosaur, right?
Right, a sleeping giant.
Exactly.
Wow.
A sleeping giant that completely missed the mobile revolution a decade ago and honestly seemed dangerously close to missing the artificial intelligence wave, while competitors basically ate its market share for breakfast.
Yeah, they really did. But under CEO Lip-Bu Tan, we are seeing what looks like a radical turnaround. They're pivoting hard into AI, and perhaps even more critically, they're leaning heavily into United States-based manufacturing.
But as always, my job on this show is to be the skeptic. We've all heard turnaround promises before from legacy tech giants. Is this a genuine comeback that you should be paying attention to? Or is it just, a lot of exceptionally well-marketed hype masking a fundamental structural decline?
That is exactly the right question to ask right out of the gate. Because the stakes here really could not be higher. What we're looking at isn't just a corporate pivot or a rebranding exercise.
Right.
It is a complete rewiring of their underlying business model. Lip-Bu Tan has come in and made some incredibly tough, aggressive decisions to trim the operational fat and redirect capital almost entirely toward future growth.
Which is notoriously hard to do.
It's incredibly difficult in the business world. They're essentially trying to rebuild the factory floor while keeping the assembly line running at full speed. The focus right now is completely on artificial intelligence and reclaiming their global manufacturing leadership. So we aren't just looking at the company 5 years ago. This is an entirely different beast operating under a strategy that could completely alter the global supply chain for advanced semiconductors.
Okay, I hear the optimism, and the narrative is definitely compelling, but I need to see the proof in the actual numbers. Let's pivot straight into the fundamentals, because the guidance they just put out is definitely raising some eyebrows.
Right.
I was looking at the broad strokes of their latest reports, and the near-term earnings seem to be flatlining. What exactly are we looking at for the first quarter of 2026?
Well, if we look at the hard numbers for Q1 2026, the guidance is showing revenue coming in between $11.7 billion and $12.7 billion.
Which is a massive number on the surface.
It's a massive number, but it comes with near zero non-GAAP earnings.
Oh, near zero.
Yeah. And just to break that term down quickly for anyone listening, non-GAAP earnings essentially strip out one-time costs or unusual accounting items to give you a clearer picture of the everyday operational profitability. So they are making billions in revenue, but the everyday profit margin on that specific quarter is sitting near zero. To put that into context, that's a step down from their fourth quarter 2025 numbers, where they brought in between 12.8 and 13.8 billion with roughly 8 cents in earnings per share.
Right, so that is exactly my point. If this turnaround is so spectacular and the CEO is making all these brilliant moves, why are the near-term earnings taking a step backward? I mean, that doesn't exactly scream hyper-growth to me.
It's a completely fair criticism, but you have to look under the hood at where that revenue is actually coming from, and more importantly, where the profits are being aggressively redirected.
Okay, where to?
The underlying growth engines, the parts of the business that represent the future, are actually firing on all cylinders right now. Take their client computing group, for example.
Okay.
That segment is up 5% year over year, hitting $8.54 billion. And that growth is directly driven by consumer and enterprise demand for their new AI-capable processors.
Right, the new chips.
Exactly. Then you look at the data center and AI segment, that's up 9% year over year, and crucially, it's up 15% sequentially from the previous quarter. But here's the data point that really jumps out at me. Their custom ASIC business has just hit a massive $1 billion annualized run rate.
Okay, let's pause right there. First, for the listener, an ASIC stands for Application-Specific Integrated Circuit.
Right.
Basically, instead of a general-purpose chip that does a little bit of everything, it's a custom-designed chip built to do one highly specific task perfectly, like processing AI algorithms for a massive server farm.
Exactly.
But let me push back on this. You mentioned a $1 billion run rate for these custom chips. $1 billion sounds like a lot of money to a normal person, But for a company generating over $12 billion a quarter, is a $1 billion run rate really moving the needle enough to matter?
In isolation, no. $1 billion isn't the entire company. But it's the trajectory that matters here. That billion-dollar run rate represents a 50% jump year over year.
Wow.
Yeah, that is explosive growth in a highly competitive sector. Tech giants are desperate for custom silicon to run their specific server needs efficiently rather than buying off-the-shelf parts. Capturing a 50% growth rate there proves they're actually capturing serious enterprise demand for specialized artificial intelligence workloads. It's a massive foot in the door with the biggest tech companies on the planet.
Okay, I will concede that a 50% jump in the custom silicon space is nothing to scoff at.
Yeah,
If you can lock in those mega-cap tech clients, that is incredibly sticky revenue.
definitely.
But I was looking at their balance sheet earlier, and there was one metric that honestly blew my mind. How exactly is a legacy hardware company pulling off this kind of margin expansion?
It's incredible, isn't it? We are seeing their gross margin expansion hitting 40%.
40%.
That is a 22 percentage point jump. In the heavy manufacturing hardware space, a jump of 22 percentage points in gross margin is practically unheard of. You really have to credit CEO Lip Bhutan here. The operational cost-cutting measures he implemented, the restructuring, the layoffs, the streamlining of product lines, it is clearly taking hold.
But having a good margin on the products you sell is one thing. Having the massive pile of cash required to actually survive a capital-intensive transition is another entirely. Building chip factories costs tens of billions of dollars.
Yeah.
How does their overall financial health actually look right now as they try to fund this?
This is where their IDM 2.0 strategy comes into play, which stands for Integrated Device Manufacturing.
Right.
Think of it this way. Imagine a world-class restaurant that, for 50 years, only cooked meals for its own private dining room. They designed the recipes, they cooked the food, and they served it exclusively to their own customers.
That was the old model.
Right. They only made chips for themselves. Now, under IDM 2.0, they are opening up their massive commercial kitchens to cook for rival restaurants. They're opening up their foundries to build chips for other companies, essentially competing directly with overseas manufacturing giants.
Which takes massive capital.
Exactly. To pull this off, they are aggressively preserving cash. They're divesting non-core assets, like spinning off Altera. And instead of doing what legacy companies usually do, which is masking slow growth with aggressive stock buybacks to artificially inflate the share price.
They're skipping the buybacks.
Entirely. Every spare dollar of free cash flow is being poured directly into their 18A node production and their AI PC pipeline. Management is thoroughly reassessing all capital expenditures to ensure perfect execution.
So they are betting the entire house on this 18A node. And just to clarify for everyone listening, the 18A node is their U.S. manufactured 2-nanometer equivalent chip technology. Nanometer refers to the size of the transistors on the chip. The smaller the number, the more transistors you can pack in, making the chip faster and more power efficient. 2-nanometer is incredibly small. That is the competitive moat they're trying to dig, right?
Exactly. That is the ultimate competitive mode. By getting this 18A node up and running on U.S. soil, they are creating technological parity with overseas manufacturers like TSMC in Taiwan.
Which is huge right now.
Oh, it's huge for ecosystem partners who are increasingly anxious about global supply chain vulnerabilities. Companies want domestic manufacturing options just in case geopolitical tensions escalate overseas.
Makes total sense.
And from a business perspective, it creates incredibly high switching costs. Think of it like building a house on a very specific type of foundation. Once a client spends millions of dollars and years of engineering time designing custom silicon specifically for the 18A manufacturing process, they aren't going to just pick up and leave for a competitor easily.
Right. The architecture is locked in.
Exactly. This protects their market share in the AI PC space, where their Core Ultra chips, which come complete with neural processing units specifically designed for AI tasks, are already powering over 200 different AI PC designs. They're building an absolute fortress around edge computing and domestic foundry services. Moving from the balance sheet to the charts, let's look at the technicals.
Let's do it.
Because the current price action is telling a very interesting story. Right now, shares are sitting around $43.10, and it hasn't been a perfectly smooth ride recently. We've seen the stock drop roughly 4.5% to over 5% in just the last few trading sessions.
Right, but when you look at the broader market tape, this dip doesn't look like a structural breakdown of the company's actual fundamentals. The selling pressure seems to be entirely driven by macroeconomic overhangs. We're talking about severe geopolitical tensions dominating the news cycle, sudden surges in global oil prices, and just the broader tech market taking a hit as institutional investors de-risk. It essentially looks like collateral damage in a macro sell-off rather than a specific indictment of their turnaround plan.
That context is incredibly important. You can't just look at a 5% drop in a vacuum and panic. What's fascinating here is the psychological support forming in the mid-40s.
Yeah.
If you zoom out just a little bit, this stock has impressively re-rated from the low 20s back in 2024 to the mid-40s now in early 2026.
That's a huge jump.
It's a massive recovery over a 2-year period. It shows a steady building accumulation flow from institutional investors who are buying into the turnaround thesis. This current level, around $43, is establishing a very strong base.
So what's next?
What the technical instructions are suggesting is that if they can successfully ignite these upcoming AI catalysts, we are looking at a potential breakout to significantly higher highs. The momentum right now is coiled like a spring, just waiting for the right fundamental trigger to release it.
But price action only tells half the story. Let's shift to sentiment and see what the market is actually saying. Because if you look at the quantitative sentiment scoring right now, it is undeniably bearish in the short term.
It is.
The recent headlines dominating the financial feeds are things like, why Intel stock is falling today, or Intel dips more than broader market. The mood is heavily influenced by those external macro shocks we just talked about.
Right.
And if you look at Wall Street, the analysts currently have a consensus hold rating on the stock, with a price target of $43.67 for 2026. They haven't issued any major upgrades for 2025 and beyond yet. It seems like the professional analyst community is just sitting on their hands waiting for proof before they stick their necks out.
Well, analysts are naturally cautious. They want to see the finished, functioning product coming off the 18A manufacturing line before they upgrade the stock and risk their reputations. But you have to counter that bearish headline noise with the positive internal undercurrents.
Like what?
Well, yes, we aren't seeing massive insider buying right now. We aren't seeing those Form 4 filings, which is the mandatory paperwork executives file when they buy their own stock, lighting up the scanners, nor are we seeing 13F filings showing big institutional whales loading up with massive cluster buying just yet.
Right.
But the sheer scale of the structural restructuring taking place implies a very high level of internal confidence. You simply do not gut your legacy operations, lay off thousands of people, and bet billions of dollars on a brand new foundry node unless you are absolutely certain the underlying technology actually works. And then there's the rumor mill, which is providing some serious speculative catalysts.
Ah, right, the rumor mill. You really can't talk about the semiconductor sector without addressing the whispers and the supply chain leaks. What exactly is circulating right now that investors should care about?
The biggest speculation swirling right now is about Microsoft. There are intense, credible rumors that potential Microsoft custom AI processors are going to be built on this new 18A node.
Wow, Microsoft.
Yeah. If that materializes, it is a monumental validation of the entire foundry business model. It proves the restaurant is open and the biggest customers in the world want to eat there. Additionally, there are rumblings that the Panther Lake high-volume production timeline might actually beat TSMC to the 2-nanometer punch.
That would be huge.
For you listening, these are the catalysts you need to physically mark on your calendar. Keep a very close eye on the late April 2026 earnings report to confirm if the AI PC traction is real, and watch for any major follow-up announcements from the CES 2026 trade show regarding new foundry customers.
That's the optimistic view, but we have to look at the downside. Let's unpack the bear case. Because as a skeptic, I see some massive hurdles that simply cannot be ignored if you were going to put your money into this company.
Sure.
The immediate threat, as we discussed, is this ongoing macro overhang. Geopolitical volatility and spiking oil prices are actively dragging the stock down right now, and if those macro conditions worsen and tip the economy into a recession, this stock will suffer regardless of how good their 2-nanometer chips are.
That's true.
But looking internally, the foundry business is notoriously brutal on margins. It is wildly expensive to run those factories. As they scale up 18A, those gross margins could face severe pressure. And let's address the massive elephant in the room. They are still undeniably lagging far behind heavyweights like NVIDIA and AMD when it comes to raw data center artificial intelligence capabilities. NVIDIA practically owns the server farm right now. How do they possibly compete with that?
Those are completely valid risks, and anyone investing in this space has to acknowledge them with clear eyes. Foundry margins are notoriously tough, and catching NVIDIA in the data center space is a monumental, perhaps impossible task in the short term. But the rebuttal to that bear case is that these hurdles are largely transient.
Transients.
Yes. First, the macroeconomic demand for compute power is so immense that it is expected to outpace global supply entirely through 2026. Every major tech company, every enterprise is desperate for silicon. There's enough pie to go around.
Okay. Yeah.
Second, regarding the lag behind NVIDIA and AMD, they know they aren't going to dethrone NVIDIA in the data center tomorrow. NVIDIA dominates the training phase of AI in the cloud. That's why this company is smartly pivoting their strategy toward edge AI, which is the inferencing phase.
Right, on the device itself.
Exactly. They want to own the processing power on the physical device sitting on your desk or the laptop in your backpack. By executing heavily on the 18A node and dominating the consumer AI PC market, they don't need to beat NVIDIA in the cloud to still generate massive returns for their shareholders.
Right.
They are playing a different, highly lucrative game. Weighing all these risks against the growth potential, it's time for the final verdict.
Let's hear it.
When you synthesize all the fundamental data, the technical setup, and the upcoming catalyst calendar, the final quantitative rating comes out to a bullish score of 7 out of 10.
7 out of 10.
Here is the final elevator pitch for you, the listener. This isn't just a legacy tech company trying to survive. It is a company positioned to completely dominate the next wave of consumer hardware. Their 18A node and upcoming Panther Lake chips put them at the absolute forefront of the AI PC market, a market that is projected to encompass an astounding 60% of all PCs sold by the end of 2026.
That's a huge market share.
It is. When you combine that massive total addressable market with their expanding 40% gross margins, and you factor in the massive U.S.-made leadership tailwinds supported by the CHIPS Act, which, remember, provides billions in government subsidies to domestic manufacturers, the picture gets very bright. And the fact that you can buy in at a turnaround discount of around $43 to $45 a share makes the thesis incredibly clear. This isn't a quick day trade. This is a multi-year hold stretching deep into the 2026 and 2027 18A production ramp.
That is a compelling thesis, and the fundamentals certainly support the idea of a long-term turnaround. But I want to leave you with a final provocative thought to mull over on your own as you look at your portfolio. We talked about those Microsoft rumors earlier. Think about the broader implications if they actually secure a massive custom AI chip deal with a behemoth like Microsoft to build on their U.S. foundry. How fundamentally does that single event permanently alter the balance of global power between Intel, TSMC, and AMD in the foundry space? If the biggest software companies in the world start migrating toward onshore manufacturing of their custom silicon, the entire geopolitical landscape of technology changes overnight. It is a fascinating scenario to watch play out. Subscribe, like, and comment to this video to support the show.